Welcome back to part 2 of our webcast on AASB 1061. In this session, we're going to walk through sections 3 to 7 of the standard, which cover the core financial statements and how information is presented within them. The statement of financial position provides a snapshot of the entity's financial position at a point in time. It shows the entity's assets, liabilities, and equity. Assets include things like cash, receivables, inventory, and property. Liabilities include items such as payables, loans, and provisions. Equity represents the residual interest in the entity after liabilities are deducted. A key requirement here is classification between current and non-current items. Current assets and liabilities are those expected to be realized or settled within 12 months, while non-current items extend beyond that period. Statement of financial performance shows the entity's financial results over a reporting period. Entities have flexibility in how they present this information. They can use a single statement that includes both profit or loss and other comprehensive income, or they can present separate statements. The statement includes key components such as revenue, expenses, and total comprehensive income. It provides insights into how the entity has performed financially during the period. Statement of changes in equity tracks movements in equity over time. This includes profit or loss, contributions from owners or stakeholders, and any other changes such as corrections of prior period errors or changes in accounting policies. For some entities that do not have other comprehensive income and meet certain conditions, they can instead present a statement of income and retained earnings. Statement of cash flows focuses on cash rather than profit. It shows how cash can be generated and used during the period, and it categorizes cash flows into operating activities and other activities, which combines both investing activities and financing activities. The T3 standard does not require investing activities to be presented separately from financing activities, but entities can do so if they consider presenting those activities separately is useful to their users. Operating activities relate to an entity's primary operations, such as receiving donations or paying suppliers. Investing activities include purchases and sales of long-term assets, while financing activities relate to borrowings and equity funding. The cash flow statement is particularly important because it helps users understand liquidity and the entity's ability to meet its obligations. The notes provide essential supporting information. They explain accounting policies, break down line items in financial statements, and provide disclosures about key judgments and estimates. In many ways, the notes are just as important as primary financial statements because they provide the context needed to interpret the numbers correctly. Thank you for watching this webcast, and stay tuned for part 3 in this series where we dive deeper into the key accounting areas.